If you're thinking about investing in US stocks, you should listen to this clip first. Listen to the information here to help you make your decision. In this video, I'll be talking about US interest rates and policies, specifically what happens if they don't cut rates, or if there are even scarier risks than just not cutting rates. If they really don't cut rates, how will that put pressure on the market and on companies? Who's going to go under first? Or the idea that, hey, all the US economic numbers right now look great. Or is the US economy actually doing well at the moment? Let's check it out together with Money Monster. So we're talking about interest rates and policy, right? This year, honestly, what's scarier than the Fed not cutting interest rates is raising interest rates. And just recently, right, Jerome Powell came out and gave a pretty clear signal that this year there's a real possibility they might not cut interest rates at all. Not just not cutting twice, not just not cutting once, but possibly not cutting at all. That's what they call a zero cut. The reason they might not cut even once is because right now the world has all the ingredients for inflation to come surging back. It's like a recipe for financial disaster, all set and ready to go, like the high oil prices, for example, because OPEC, which is basically Russia and the Middle East, when they say, let's cut oil production, that alone drives oil prices up. And then there's the war, which makes exporting oil even harder, so oil production drops even more, and prices go up again. As of around March 31st, crude oil prices had already climbed to about $91 per barrel. And then there's food prices too. Ever since the Russia-Ukraine war started, right? And Russia and Ukraine are major grain exporters. The world has been able to export less, especially from Ukraine, which can't ship out through the Black Sea grain deal anymore. That's made global food prices skyrocket. And look at India, for example. They've stopped exporting rice altogether, which has pushed rice prices even higher. UBS and JP Morgan have both said that an even scarier risk than the Fed not cutting interest rates is that the Fed might actually raise interest rates. In 2025, it will be 6.5%. So if the Fed raises interest rates from the current level of just over 5% to 6.5%, what we'll see is the stock market or the S&P will drop by 15 to 20%, or maybe even more. Why does a rate hike cause the stock market to fall? Let me explain it clearly so you can picture it. When interest rates go up, even without raising them yet, just the prospect of higher interest rates means companies will have more debt due to increased interest expenses. And interest, of course, is a financial cost. So if a company earns the same amount as before but now has more debt, the first problem is that profits go down. The second problem is they might not have enough money to pay off their debts. And the third, which is the worst, is that if they can't pay their debts, they could go bankrupt. That's why the stock market can drop, because when interest rates go up, it means debt increases. More debt reduces the amount of capital or cash that listed companies have, which in turn raises risk. As risk goes up, stock prices fall, or in some cases, companies might not be able to stay afloat and could go bankrupt. But then some people say, but the current US economic numbers look really good. Is it really possible for the economy to collapse like that? We need to take a closer look. First, let me explain just how good the US economic numbers are. The GDP is at 4.2%, the unemployment rate is quite low at 3.8%, and corporate profits are doing really well at $3.8 trillion. The S&P 500 index is also above 5,000 points. Speaking of unemployment numbers, payrolls are currently very high. In the most recent month, payrolls increased by 330,000 positions. However, these exceptionally high payroll numbers or employment rates might not actually reflect the true state of the US economy. David Miracle, who serves as a senior economist at Goldman Sachs and focuses on US economics, said that the reason payroll numbers have experienced such a significant increase is because the US includes employment figures from immigrants or migrant groups, and there has been a very large influx of immigrants coming into the US lately. This has been happening since after COVID-19. As for the GDP numbers that have risen this much, there's research from Brookings, a nonprofit organization based in Washington, D.C. They released a report stating that the high GDP numbers in the U.S. are actually driven by deficit spending. If you look at this graph, the top line, which is currently at a negative 6.3%, shows that the U.S. has been running a deficit policy for a long time. In the most recent year, the deficit was negative 6%, and the money is coming in from borrowing as well. The U.S. government has been borrowing heavily. Right now, the national debt has reached $34.6 trillion. This is from selling government bonds, which means it's all dead. So even though a lot of money is coming in, the interest rates are so high that it doesn't seem healthy for the economy. This is the point where we as investors need to pay attention to see what policies the U.S. will implement going forward. How much longer will we keep borrowing more and more to maintain these GDP numbers? Or will they eventually let the economy crash? There are people who think differently, though. There's another side that believes, hey, maybe raising interest rates and these policies could actually be good for the economy. Because if policy interest rates go up, the yield on government bonds will also increase. And if government bonds offer higher yields, that just means they pay more interest. That would make investors even more interested in buying government bonds, and money would flow into the United States. The more money comes in, the more it circulates within the country, which could help keep the economy afloat. But do you remember how the price of government bonds and their yields work? Here's how it goes. If new government bonds are issued with higher yields and pay more interest, the older government bonds will drop in price. So if newly issued U.S. government bonds are expected to keep offering higher and higher yields, investors will hesitate to buy, right? Because they already know that if a new batch of bonds comes out with higher yields, the ones they buy today will immediately lose value by 2 to 3%. People who invest in government bonds know this very well, and you can see it right here. Just look at how sharply the yield on the 10-year U.S. government bond has risen. Check out this graph. The line shoots up from 4.35% to over 4.6%. That's a huge jump, and it causes the price of previously issued bonds to drop immediately by 2 to 3%. Now let's look at the 20-year bond. This graph shows the yield trend for the 20-year government bond, and you can see it's been on an upward trend the whole time. Janet Yellen, the Secretary of the Treasury, keeps issuing new government bonds with even higher yields and interest rates. This just causes the prices of older bonds to drop even more. That's why, even though U.S. government bonds today have yields as high as 4.5%, there are still investors buying them. Not exactly a small number, but not enough either. So if anyone goes to buy, if you look at government bonds back during the COVID-19 era, when interest rates were at historic lows, you'll see that the market prices back then were significantly higher, right? But now those prices have dropped a lot. The banks that collapsed in mid-2023, like Silicon Valley Bank, this was the main reason. They had bought U.S. government bonds, and then the prices just plummeted to much lower levels. Next, if you ask, if interest rates aren't lowered, who's going to be the first to go under? The industry in the U.S. that will be hit the hardest and most visibly is commercial real estate or office buildings. Since last year, U.S. commercial real estate has been showing signs that it just can't make it anymore. After COVID, fewer people have been renting, and then they got hit with rising interest rates on top of that. The amount of commercial real estate debt in the U.S. is huge. This year, nearly $1 trillion in commercial real estate debt is coming due. The actual number is $929 billion that needs to be refinanced this year. The reason the number is so high is partly because some of the refinancing that was supposed to happen last year got pushed to this year. Why? Because the market was expecting that the Fed would lower interest rates in 2024. But if the Fed doesn't cut rates, it's going to crush those hopes. Take a look at this graph. The numbers below the line represent the amount of debt that was pushed from last year to be refinanced this year instead. Instead of refinancing last year, the amount that could be postponed was moved to this year. But if the Fed doesn't lower interest rates, it's going to shatter the hopes of this group who were counting on that. They were hoping that refinancing this year would get them a lower interest rate. But since the Fed isn't cutting rates, they'll end up with the same high rates, or maybe even higher. Why? Because commercial real estate started to struggle a lot since last year, right? So there's already a huge amount of bad debt piling up. Regional U.S. banks have found that commercial real estate, or office buildings in the U.S., have accumulated a massive amount of debt. And even if the Fed keeps interest rates the same, the rates are still. The payments on these commercial properties might even go up. Because of the risks in this industry, banks, since they can't collect on these bad debts or earn any interest from them, are facing even more risk in this sector. So banks have to set aside more reserves. And when banks increase their reserves, it means they have less money available to lend. With less money to lend, but the same number of people, or even more, wanting to borrow, it becomes harder to get a loan. And when it's harder to get a loan, that means interest rates have gone up, and let me show you this. This is the prime rate. The prime rate is the interest rate that commercial banks charge their best credit customers. Take a look at this graph. Most recently, it's at 8.5%. This is with the policy interest rate at 5.5%. So banks are lending at an 8.5% interest rate. And keep in mind, that 8.5% is only for top-tier customers. If you're a higher risk customer, the rate can go up a lot more, sometimes even over 10%. It's possible for the rate to go even higher. So if the Fed doesn't actually lower interest rates, there's a real chance that the US stock market could trend downward even more. And if there's a sudden hike, if interest rates go up again, the market could drop significantly, especially riskier assets like Bitcoin. Because last time the Fed raised interest rates, wow, Bitcoin's price crashed hard. If you enjoy this kind of content and want to support me so I can keep researching and sharing updates like this with everyone, it's really easy. Just hit like, share, and subscribe to my channel. Thank you.